Hello and good morning. Morning, chaps. How are you?
Well, good yourself.
Very well, thank you, Lee. Yeah, how are
Very
you?
good indeed. Very good indeed. We've just been moaning about the football, the kickoff times, and everybody feeling tired and fatigued. But Friday is upon us, another webinar and another session with you guys, which we absolutely love. We're literally just knocking these out the park at the moment, different sort of not problems, but different things cropping up in the industry at the moment. And today is our risk profile still fit for modern financial planning? Because it is a question that's asked all too often at the moment, isn't it, gents?
It
Big
certainly
time.
is. Yeah, we've been speaking about it a lot recently. Yeah,
Good stuff. Good stuff. As always, good morning and welcome to Club Live. I hope you've all had a great week. I know people will be in the comments, and I need to open that up and pull it over onto my other screen so I can see just to make sure everything is working as it should. Good morning. Good morning, Jade. As always, if you've got any questions throughout today's session, please do not hesitate to ask the question. Whether you want to do it in the chat function where you can see Jade saying happy Friday, or if you'd like to do it a little bit more anonymously, there is a Q&A section which comes directly into myself, Lewis, and Francis. Feedback is key to what we do. When you exit today's webinar, a feedback form will pop up. Please let us know your thoughts on today's session, how you found it, how you found the speakers, whether it's engaging for you, whether we hit the mark with the subject and the content. Please do let us know. Always, as always, if you want CPD from today's session, again on the feedback form, at the bottom, it'll ask, do you require a CPD certificate? Let us know there, and we will get one over to you as soon as we can. So talk to us if you've got a question, and complete feedback at the end are key to what we do. So thank you very much for joining us again today. Let's kick things off as soon as I find the next button. There it is. Just quickly touching on who we are at the Financial Planning Club. Amanda run two national financial planning businesses, one on an employed arm, one on a self-employed arm. Myself and Lewis have run a fixed fee subscription recruitment business over the past 10 years, really focusing on growth, scaling of businesses, and culture within those organizations as well. Jade is the backbone to everything we do. She is the glue to the business, and she is the get stuff done girl, being very polite there. Get stuff done girl is what we call Jade. So thank you everybody for joining us. I've shared my QR code today because after every webinar, I do create little short reels from the content. I do create little newsletters as well. So if you want to stay up to date with what's going on in this webinar, previous webinars, and up and coming webinars, do scan the QR code, give us a little connection on LinkedIn to stay up to date. But that's the club, but we couldn't do what we do without the huge backing and support of every single one of these collaborators. From tech to MPS to CIPs to compliance, AI. We've got so many firms that are now collaborating with the club, not only delivering outstanding content, but providing that real one-to-one support with business owners that are looking or going through change within their organization. So massive shout out and a thank you to everybody that is now collaborating with the club. Just got to touch on this briefly because I know a lot of people do come from our WhatsApp groups, but outside of the consultancy, the one-to-one for business owners, we do like to create a community that works for everybody. It's an industry where it can feel quite isolating to a degree. So we've got separate peer groups, separate communities, depending on the role that you play within your organization. So if you're an owner, whether you're an advisor, a power planner, an ops manager, mortgage advisor as well. You know, there's plenty of different communities where you can hang out with those that are playing a very similar role to yourself. So any technical question, any support, any ideas, our WhatsApp communities are absolutely thriving, and they're a very willing and participating bunch. They do, respond quite quickly. So if you do want to join our communities, again, in the feedback form, you can request to enter one of our communities. One piece of advice, do put the group on mute. The Paraplanner group is, I think there's about 500 people in the Paraplanner group. So it does get quite busy. Club Lives are our webinars every single Friday and the occasional Wednesday as well. real good topics, real good subjects that we're covering. All of them are CPD accredited, very much like today's session. The financial planning podcast is where you can hear the stories of business owners. So if you do have a story, you're growing a financial planning firm, you've been on an amazing journey or whatever it may be, if you'd like to come on the podcast, again, do let us know and we can get you on our weekly podcast. What we got coming up, navigating the new world disorder. We are with Tatton. So this is going to be really, really good. So we're going to discuss the key geopolitical and economic forces shaping markets and what they mean for investors and portfolios. On the 10th of July, Bearrock will be looking at consumer duty aligned client satisfaction surveys and how firms can better evidence good client outcomes. And new to the arena, really, not as a collaborator, but FE will be exploring vulnerability protection and the visual client journey, looking at how planning tools can improve client understanding and engagement, really on the mortgage advice front as well. So it's going to be a really good webinar, that one as well. So Tatton, Bearrock and FE Fund Info are the next 3 webinars lined up all the way up until the mid of July, which is very, very good. Joining me today, the incredible Aspen. I think this could be our 6th webinar, maybe. We've done a few now, Lou, right?
Now. Yeah, lost count. And it's took out 6, of which 50 have been in coffee shops, 50% have been me at home. So
yeah. Lou has a tendency to pick random places to do webinars and makes me sweat a little bit when he turns up a minute before.
It's a busy life on the road, mate. It's what it is.
Francis is Aspen's regional director for the North, working closely with advisor firms across the region, while Lewis is head of strategic partnerships, helping to build and strengthen Aspen's relationships with financial planners across the UK. Incredible and great to have you both with us. I know we're going to kick off a poll for the first before we go live, but just really taking a little look at the room, a mixture of advisors, owners, power planners that are attending today's webinar. The biggest challenge is balancing growth expectations with clients' tolerance for risk and volatility, which makes today's session particularly relevant, which is all good. Now, because I'm on a different screen, I just need to find where we're going to kick start this first poll. And this is really confident in risk profiling, is it? How confident are you that current risk profiling reflects how clients actually behave in volatile markets? Now, we're doing this on a scale of 1 to 5. 1, I believe, being, I don't know, how are we rating this? 5 being the most confident?
Yeah, I would say
5,
so. Yeah.
5 being the most confident.
Yeah.
5 being the most confident.
Which is unsurprising with the current votes, I think, coming in.
Yeah.
So, yeah, this is going to kick things off straight away, isn't it, really, and just get to the crux of what the webinar is about, which is very, very good. Where do you typically think the polls are going to land, gents?
I'd say to be honest, it's pretty set in the middle, probably like a 2 or 3 out of 5. We asked this question last week, and the feedback from a lot of people was okay, tick a box, but it's not really a real reflection of the conversations that planners are having. And I think this is kind of what we're going to go into today. And the big challenge, it's how do we evolve it then? So when we talk about risk, we are actually having a reflective discussion of the conversations that you're actually going to have with clients as part of that.
Because how often do you see clients' actual behaviour differ from what their risk profile suggests?
It's difficult.
Yeah, it's challenging, and I think behavior is driven by what's going on at that particular time. So if there's market volatility, people's behavior might change slightly. But if there's, like we've experienced in the past 3 years, been some really positive markets, if the client's filling out a risk profile at that particular point, they may feel slightly differently. So a lot of it's driven by what's going on in the universe at that particular time.
Yeah. Final question from me, and I'm happy for you to say we're going to cover that today, but what is the biggest limitation of traditional risk profiling tools today?
Oversimplification.
What was that, sorry?
Oversimplification, I'd say.
Okay.
If you look at just looking obviously what you brought up now in terms of like biggest challenges, clients' expectations for growth, willingness to accept risk and volatility, alongside that, what people want to explore, that more sort of goals-based approach.
Yeah.
This is the problem. To say to the biggest challenge I think people face with risk profiles is, okay, I've got a client, they might be, and we'll cover this today as well, but it could be they're coming to a financial planner to help plan for retirement, but they might
Mm.
have 15, 20 years away from retirement. So actually, you'd probably think, you know what, you need to really take some risk there to get your portfolio to grow. But they might have answered that questionnaire completely differently because they're just talking about overall risk. And at the end of the day, that client could be answering that questionnaire completely differently because actually,
Mm.
whilst they're trying to plan for retirement, they also are conscious of the fact that they got money they're going to need for a house purchase soon, or funding a child's wedding, or put more money into your emergency fund. Like they'll have different pots of money they need for these different solutions. And to basically just say, right, clients who are complex, they do have varying goals, varying time horizons. To simply say, we're going to take all of that and package you up into one single risk profile score, it's just oversimplifying it. That's the biggest risk. I think the biggest challenge I think we're seeing with risk profiling at the minute is the oversimplification of goals.
Totally agree. And we'll look at of what some of the things that the regulator is saying on this,
Mm.
specifically around shoehorning. We'll touch on that in just a moment.
Brilliant. Over to you guys.
Cool. Cheers.
Excellent. So those results. I'll share my screen. If bear with me just a moment.
Yeah, and please feel free to ask us any questions as part of this. We'll make it as engaging as possible.
Can you, Lou, let me know if that's working correctly?
Nothing's showing up so far. Here we go. Yeah, that's it.
It's not. Is that in a full screen?
Not the full screen yet, no.
Okay, let me share this. That's better.
That's it.
Excellent. So yeah, thank you as always, Lee, for that very warm introduction, and thank you everyone for taking time out of your Friday morning to talk to us or listen to us talk about a topic that it's coming up more and more. I think there is, isn't it, in conversations that we're having with financial planners. Really, what we're going to be looking at is, our risk profiles still fit for modern financial planning, and that movement, that evolution that we're seeing from risk profiles to more of a goals-based investing approach. I do have some introduction slides here, but Lee's already done a fantastic warm introduction to both of us, so I'll keep this very brief. I'm Francis, Regional Director in the North. I look after all of our financial planning partners across Northern England, Scotland, and Northern Ireland. I'm delighted to be joined by Lewis, who's our Head of Distribution. Lewis, do you want to say a few words?
Yeah, it's nice to meet you all this morning. So I think this is, yeah, Lee, obviously you asked that question earlier about things like what challenges people are currently facing. That's ultimately what led me to actually join Aspen in the first place. I was at a previous company, another well-known provider, and I was going through my financial planning exams, and the more and more I studied, I just didn't feel that that a lot of the planners that I was working with at the time really we're getting the best from providers in terms of really getting the solutions that reflect the conversations they're having. So for me, I wanted to join somewhere that I generally thought was at least moving the industry forward and
Mm.
providing solutions to clients that, or I say clients obviously being advisors, but yeah, providing solutions to advisors that actually reflected the conversations they're having. So yeah, it's been an amazing journey so far. I was employee number 4 in the door. I think we had 6 firms when I initially joined. About 70 million of assets under management, which I'm sure most of you will probably have more AUM as yourselves alone. And yeah, growing very quickly as a business. So we're now at 104 firms we work with and about 900 million of assets under management. So it's been a quick journey, but it's just, yeah, really delighted to have these conversations. And yeah, thank you obviously to the Financial Planning Club for having us on because you've been a core part of our growth journey.
Anytime, guys. Anytime.
Absolutely. So these are some of the things that we're going to be discussing today, but really there are 3 things that we hope you all take away from this morning's session. The first is an understanding of the evolution that we're seeing within risk profiling and that transition towards more of a goals-based approach. The second is just how to construct a CIP that actually aligns with that way of thinking. And then we're going to look at some of the solutions that are available in the marketplace for you to use to populate a CIP that looks at goals-based investing. Before we get into the core content, though, for the benefit of people on the call that haven't yet met Aspen, I'll just spend 1 or 2 minutes just running through a brief overview of our company. Now, it's Friday morning, and some of you may be thinking, oh, great stuff, is DFM number 150 come to talk to us about investment management. We are very aware we operate in quite a saturated part of the market. So when we set this business up 6 years ago, we understood that we needed to do things differently. We needed to stand out from the rest. And we believe we achieved that through these 4 principles. The first is choice. We do have one of the most comprehensive range of portfolios in the market. There are 32 model portfolios available at Aspen, and that's not just endless risk profiles. There are actually 5 risk profiles in the main range, and then 5 investment styles. And then we've pioneered the concept of satellite investing. So there are 7 thematic satellite portfolios that financial planners use to align with specific goals within a client's financial plan. So very relevant to some of the stuff that we'll be talking about this morning. The next is efficiency. So we streamline the investment selection process through best-in-class technology, and Lewis is going to run through a demonstration of that towards the end if we've got time. The third is service. So service is really important for us here at Aspen. It's really important. We see ourselves as a dedicated investment partner for all financial planning businesses, providing everything you need from the investment side of your roles. And then the fourth is nimble. So we are a relatively small business, which works really well for us because it gives us an ability to get stuff done and adapt at pace. And an example of that was back in 2022. We were one of the first providers to come to market with a gilt portfolio available across most UK platforms. And that was at a time when gross equivalent yields were very high for those higher and additional rate taxpayers. They are now again back in favour, and gross equivalent yields are back up for those higher and additional rate taxpayers. Really looking for cash-like solutions for that shorter term goals. Again, very relevant for some of the stuff that we're going to be talking about today, and Lewis will touch on that in just a moment. But the core content for this morning is going to be looking at risk profiling and that movement towards client goals, as I've just mentioned in a moment. And I believe before we get into that, Lee, we're going to be running another poll at this point.
Yeah, we're going to kick off the next poll, guys. When clients talk about their money, what do they focus on most?
And as Lee's mentioned at the start, please do ask any questions in the chat or Q&A. The benefit of having all 3 of us and Jade monitoring things as well is that we can pause and answer them as they come in.
Do you guys notice a bit of a shift in anything? So when markets become volatile, do client conversations or advisor conversations tend to shift away from long-term goals back to short-term?
Big time. It's funny because obviously standard, say, risk profile questionnaire that an advisor will go through with a client. The client might circle, yeah, do you know what? I can withstand like a 20% fall in the portfolio because I've seen the chart which goes me from point A to point B. Like that's what I want. When that situation actually comes up, though, clients behave completely differently. It's like they never were expecting this to happen. So yeah, it basically then goes to a conversation of, right, we told this was going to be the case. What's really important now, and like I said, in terms of the short term, is that we don't react. So I think this is where a lot of people are changing their conversations now in terms of providing more visual aids. And we'll touch upon that in a moment as well in terms of the sort of visual aids you can bring up with clients to help navigate through market volatility. And it's just having that educational conversation of, well, actually, let's look at what this money's for. Are we growing it for the long term or is it short, medium term? Because yeah, if you've got a short term horizon for one of your solutions and one of the goals, and the solution that goal is invested in ends up falling by 20%, yeah, do you know what? Big concern. But yeah, we definitely see a big change when those situations actually do happen.
Yeah, and look, asking you guys and also the audience, are you noticing a bit of a shift or a change in client conversations over the last few years, particularly around inflation, interest rates, market volatility? Has there been a bit of a shift from the long term to more short term, a bit more certainty, a bit more security rather than long term growth aspect? I'd be interested to hear your thoughts and the audience really. Are they seeing a bit of a change in it?
It's interesting because I've had this conversation with financial advisors quite a bit, and clearly, you guys on the call will be able to give richer insight on that question. But I do wonder if, more generally, we're living in a world where people expect things a bit quicker.
Yeah.
And that can then translate across into investment management, with performance. Actually just staying the course over the long term is the most important thing. And if returns aren't coming as quickly as they expected, or if losses, they may panic a little bit more. And I wonder whether that's a reflection of the world that we're sort of living in at the moment.
For sure. Look, even when we buy something, if it's not next day delivery, we're looking for an alternative product, right?
Yeah, that's it. Yeah.
We are very impatient.
Yeah.
Exactly. I think also, Lee, your point, what you mentioned about Tatton's session, I think you said is next week or the week after. I think,
Yeah.
yeah, very well timed because we have this from advisors, but also their clients quite a lot in terms of people that are looking to move to Aspen. It's usually because we do manage risk, I suppose, or have at least active oversight compared to most.
Mm.
And I think a lot of people now, in terms of, yeah, I've been wanting to invest maybe in a full passive solution, which is nothing wrong with that, by the way. It's a completely reasonable solution. But I think what people said about their biggest challenge about client expectations is people want the growth of a full passive solution, but they don't want the volatility associated with that. So we're having so many client conversations now because people see the things that are happening with the US and Trump, Iran, Russia is a good example of that as well. There's so many
Mm.
different things in the market at the moment. It's really scaring clients, and I think it
Yeah.
just does feel like it just feels like a really uncertain time. So yeah, we're definitely having more conversations around that at the minute.
And is that, holding people back from investing over the long term? Are
Yeah.
people looking for shorter, quicker outcomes? Just looking at the feedback from this poll, a lot of people are coming to the table with specific goals,
Yeah.
which is obviously expected, but
Yeah.
also they're quite unsure, right? And they're relying heavily
Yeah.
on the planners and the advisors' guidance.
Because when it's volatile, people are unsure about whether they should be investing. No one invests when there's sort of negative sentiment on the news. Everyone
Mhm.
invests when markets have reached all-time highs.
Yeah,
So it's just a really a challenge one that advisors obviously have to navigate with those clients. But yeah, I think this is where a good advice conversation, educating the clients, but also even just starting to get them invested. It might say, "Do you know what? Let's invest you for a risk profile, say 6 out of 10 for the moment." And over the next 12 months will gradually increase your risk as you get better understanding of a risk. So actually, I
yeah,
think if the client's coming to an advisor for a first time, it's really important that 12 months down the line, or maybe 18 months, 2 years, wherever you want to do it, do that risk profile again because their circumstances may change. They may have
Mm.
a completely different expectation of risk now because you've been able to really educate them and give them a good experience on what that actually
Yeah.
looks like as you work closer together. So I'd always revisit that conversation.
Yeah, yeah, exactly. It's not even just their attitude or their circumstances. It's their emotional attachment to
Correct.
market volatility, right? It's
Yeah.
you do an ATR with somebody today, and the market jumps and
Yeah.
drops next week. Their ATR might be completely different, right? It's just
Absolutely.
Exactly that.
Yeah,
because
yeah.
they've reacted.
Absolutely. Completely
Back
agree.
over to you guys. I've
I'm,
shared the results. Yeah, insightful.
I'm gonna come back to those results in just a moment, actually, because I
Cool.
thought one thing was particularly interesting in that the on the screen now you'll just see a number of the risk profilers that are available out there in the marketplace, and I'm sure some of you on the call will use one or two of these. Um, and then, of course, we've put our own software on there. So some investment managers like ourselves have developed their own software, and of course, financial planners may have developed their own software as well. But there were really two observations that we've made when working with these risk profilers and in the construction of our own software. And the first one is that each one of these providers assesses risk slightly differently. So whether that's out of a score of 5, 7, 10, or 100, even when we find risk profilers who score out the same number, a different set of questions could result in a different risk score for a client. So for the same client. So that potentially means that clients are getting different investment outcomes depending on the software being used by the financial planner. The second observation that we've made is that clients don't tend to think about things in terms of risk scores at all. So we put this question to a lot of financial planners. I mean, I've asked this question to hundreds of advisors over the past couple of weeks. We ask, have you ever had a client walk into your office and say, "I'm a risk profile 5 out of 10. What investment solution have you got available for me?" And out of the multiple hundred advisors that I've asked over the past several months, I've had two advisors say that they've had one experience of that, And both of those experiences were from clients that were in the industry and understood risk profiles and actually done a risk profile on themselves already. So generally speaking, clients, we don't think, go to financial advisors and say, I'm a risk profile X. What investment strategy have you got for me? And actually, I thought that came across in the poll that you just did there, Lee.
Yeah.
So when asked, when clients talk about money, what do they focus on most? None of you on the call actually said how much risk they can tolerate, which I
Yeah.
thought was very, very interesting.
It is. And look, if anyone, I'd be interested to hear from the people in the room. Has
Yeah.
anybody in the room had some, a client walk into them and tell you their risk rating? That would be interesting. Just yes or no. Have you had it?
Yeah. And generally, the reason why that doesn't happen is because clients don't think about things in that way. Clients tend to think about things in goals, dreams, and objectives, not just risk profiles. And I think financial planning gets that. Financial planning understands that. That came across clearly in that poll that you just ran there, Lee. But as an investment management industry, we've become fixated on creating model portfolios that just align to a specific risk score. And if we look at, let's say, £500,000 of investable wealth, under a risk profile based approach, financial planner would sit down, do a risk score with that client. In this scenario, they've come out a 3 out of 5, and then we'd place the full amount in a medium risk investment. So just shoehorning them into one singular investment to cover all of the goals that they've got. In a goals-based approach, we'd sit down with the client, understand what they're looking to achieve. We'd separate those objectives out into different pots, and we'd choose a sensible investment strategy that's going to give them the best possible chance of achieving those goals over the given time horizon. And the outcome of that is often a more suitable portfolio structure, as well as greater confidence and understanding from the client. At this point, I sometimes reference Monzo Bank, and I'm sure a lot of people on this call will have come across Monzo, and maybe even you, Monzo. I use Monzo personally for my own spending, and they've been incredibly successful at tapping into this way of thinking. They enable users to separate out their money into different pots and actually assign a title for the reason why they're saving. So me and my wife went on a holiday, our first holiday with our 10-month-old, just a couple of months ago. And, in order to fund that holiday, we set up a pot in Monzo, and we called it our holiday fund. And that enabled us to pay for the flights, pay for the apartment, and spending money when we're out there. And then later this year, we're planning to do some work to our garden. So we've got another pot set up for our house renovation money. So they've been incredibly successful at tapping into that way of thinking, of separating out goals into different pots. And we just wonder, is there a way that we can implement a similar strategy within financial planning? So what we do in order to consider that is look at the two in isolation. So risk profiling first. What does it look to achieve? So risk profiling looks at the client's willingness and capacity to take risk. However, it can often oversimplify things, as Lewis mentioned before. That's probably one of the biggest challenges that we see. It can oversimplify things, and it may be overweight a specific risk score. So, just prescribe one risk score, and therefore the client goes into that investment strategy. If we look at the goals approach, we're looking at what does the client wish to achieve and over what time horizon. In this scenario, it can be more complex, and of course, goals can change over time. So we wonder, we really believe the optimal outcome is a combination of the both. So we frame the conversation around goals and objectives, and then we assess how much risk is needed to achieve those objectives over the given time horizon. And actually, this aligns into the FCA's thinking on this. So the FCA have actually told us that client advisors should avoid shoehorning clients into portfolios based on risk scores alone. And suitability should be driven by client objectives, not just alignment to a risk category. Actually, in addition to this, what the FCA have also told us is that risk scores shouldn't take precedent over advisors' own judgment of that client. So we understand that this actually does align with the FCA's way of thinking about things. We're going to move into just discussing how we might be able to push the two together and find that optimal solution. But I believe we might have another poll to run with.
We do indeed, which I'll launch now. This is all about implementing the goals base really. It's interesting on the chat, guys, right?
Yeah,
You know, it's
about to mention that.
yeah, it is interesting, right? You know, guys walking in and having a higher attitude to risk, and then actually experiencing a bit of market volatility, and actually going, oh, maybe I don't like that much exposure, or it's an
Yeah.
interesting concept, isn't it? Really?
100%. I think this is I'm going to start with James's point there. Like every client thinks they're conservative average risk. 100%. You give
Mm.
anyone a scale, they usually go average.
Yeah,
No one sort of really puts himself as, oh yeah, I'm a really high risk in client. It's all subjective as well. It's like, do they actually understand what average
yeah,
risk looks like versus high risk looks like? What
yeah,
actually the difference between the two? But yeah, it is different actually, and seeing actually well. I think Jack's mentioned it in terms of the sort of difference between men having a higher risk profile, but when it comes down to it, usually more nervous. 100%, it's that overconfidence bias. I'm not sure if anyone saw it recently. There was a survey, I think it was recently, it was a couple of years ago now, probably, where they asked people basically out of everyone that they've surveyed, who would they reckon could land a plane? And over 50% of men surveyed thought they could land a plane.
of course we
And
can.
exactly. It's just like, but actually in the real world scenario, saying that one thing and then being
Yeah,
presented with the actual scenario itself and saying, okay, right, plane's about to crash. Have you got someone that can actually land the plane? Who's going to put the hand up? I'll be interested to see how many of those same people say, do you know what? I think I can do this. Let me go do it.
yeah.
It's the sort of theory versus reality bit for a lot of people. And yeah, expectations, it all comes down to.
It's almost like onboarding a client and doing the first attitude to risk, and then seeing a bit of market volatility and running another attitude to risk at that point and go, well, this is the real attitude to risk. If we
Correct,
look at
yeah.
the difference between A and B, you're probably sat here, not quite where you thought it was because you haven't actually physically experienced it. When in reality, this is how this is your attitude to risk and how it makes you feel.
Correct.
Yeah.
Um, let's have a look at this poll. I reckon I could land the plane as well, James. I reckon I will be landing that plane. If you would like to be the only passenger of that plane,
Yeah.
without too many other people aboarding,
Yeah,
come and
James.
join me. You could be my
James, would you
co-pilot,
back
James.
him if Lee was
Co-pilot,
actually the
yeah.
one on the plane landing it? If you had to sit on the same plane,
There are simulators, right? I think that'll be the next club incentive, right? We could go and do a simulator, and I will land that plane, James.
that'd be a great idea. To be fair,
Yeah.
or maybe London
Nice.
event F1 arcade, something like that at least.
Yeah, yeah. I'm not a car lover, to be honest with you, but
Planes, yeah, okay.
I'll probably win that as well, Lou. I'm just going to share the results on this. So translating goals into investable portfolios, time and process, complexity, compliance and documentation. I
Mm.
mean, this is pretty much what we expected, right?
Absolutely, yeah. I think touched on it a bit before, actually, translating goals into investable portfolios. I think as an investment, managers, we've become, or we've just fixated on providing 5 or 10 risk-rated portfolios, and that's it because it's easy. And actually, there's more work that needs to be done in the investment management space to actually create solutions that are going to align into goals and objectives. So, yeah, I thought that was interesting to see, and we'll maybe share some of our thoughts and answers on that in just a moment.
Absolutely.
Yeah, that's part of the session we're going to help people today in terms of translating those solutions into goals.
Yeah, absolutely.
Perfect.
So when assessing goals, we believe that this can be done across 3 key time horizons. So we've got those short-term goals that focus on liquidity, security, and planned spending. So that's the building up of your emergency fund or any near-term purchases. So in my case, it was the holiday a couple of months ago and some house renovation later this year. We've then got those medium-term goals, so that typically focus on wealth accumulation and life milestones. So that might be funding education, moving house, building up a financial buffer, or growing an investment portfolio. And then we have those long-term goals, which focus on capital growth, legacy, or retirement. And then when we see clients entering into retirement, goals can become even more complex and varied. So the types of goals that we tend to see advisors telling us their clients have in retirement are those lump sum initial goals, so taking of tax-free cash, perhaps to gift to family members or to charities, to pay down some debt. Perhaps they don't want to take that mortgage into retirement with them. There's then the income needs, so living expenses, care costs as they get older. the legacy planning, leaving assets to family, and then longevity of the pot. So we know we've got an aging population here in the UK, and retirements are lasting longer. So it's important that the pot of money that they've got to spend in retirement lasts as long as their retirement does. Even though the retirement goals can be more complex and varied, we still believe that they can be bucketed across three different time horizons. So we think about things at Aspen, those short-term time horizons for liquidity, so those immediate cash needs, managing sequencing risk, and that's where managing sequencing risk is at its highest. We've then got that middle bucket for the medium term we call lifestyle, so that's supporting the current and desired lifestyle. And then we have that long-term bucket, which we call longevity, to sustain and grow the portfolio over time. So what we've looked at so far through the slides and in the polls is that evolution from risk-based investing towards more of a goals-based investing. And we've looked at some of the goals that clients may have throughout all of their life, both in accumulation and then in retirement. What I'm going to do is stop sharing my screen and pass over to Lewis, and we'll look at how to actually construct a CIP that aligns with that way of thinking and some of the solutions out there in the marketplace.
Yeah, it touched upon your the questionnaire you mentioned a minute ago, at least in terms of the sort of what in terms of FCA outcomes, and people saying actually just aligning the goals with the appropriate solutions is probably one of the hardest things. It also comes into Kaylee's point there in terms of clients actually generally have an idea of maybe what they want to gain, but also what they don't want to lose. And this is where we're trying to see the industry evolve now in terms of beforehand, you had a, say, like Francis mentioned, medium risk profile, great, all your assets go into that. Now imagine in 2022, you got clients come out of 1 or even a 2 out of 5 in risk. Now, they've got the vast majority of their assets held in bonds, which should be a defensive asset, and that's because they don't really want to lose that much money. But at that moment in time, the bond market fell by about 20 to 30%. So suddenly, a low risk client suddenly saw a shock to their portfolio they were not expecting. And this is the whole point. Well, it depends on what the client's actually investing for. Because if they put actually, for this particular goal, it might be a 1 out of 5, it could be a house purchase in 3 years. Well, actually, it's just about getting some form of interest rate return then. You're not really wanting a equity bonds portfolio at all. But this is the problem. People are basically having 5 risk rated portfolios and saying, okay, clients count 1 at 5, there it is. It's like, well, do you know how that particular investment solution behaves in line with what the client's actually trying to achieve? And that's where the goals based investing approach really comes into it. It's about aligning solutions that behave in line with the goal that that client has in particular that people want to look at instead. So yeah, I'm just going to share my screen 1 second.
I just stopped sharing my screen then, and I realized, was I sharing my screen just a moment ago?
Yeah, you are.
Yeah, cool, brilliant. I'm toggling 2 screens, so I'm not sure what's up or not, but yeah.
Yeah, all good.
So that moment when you drive it and you realise, how did I get in the fast lane?
Can everyone see that? Okay.
Yeah.
Yes.
Cool. Perfect. So when you look at a CIP for a goals-based investing approach, this is basically looking at now, well, what's your toolkit? So there's a few different options for people in the space. So you've got traditional discretionary investment management. So this is more sort of bespoke investments where people are maybe building portfolios of individual securities. Some things basically going to be more complex with that. They're going to maybe have a feeling of more personalized approach and solution. But at the end of the day, it can be high cost as a result. But for the right type of client, especially those with some really complex sort of cherished holdings, especially in one in the ESG space that has some exclusionary preferences, traditional discretionary is still a popular option for those. Outside of that, we're starting to see that fall away a little bit by most financial planners, just because actually you can still do a personalized solution outside of a full discretionary manager now as well, using building blocks of funds, MPS. So you can usually get the same sort of solutions for half the cost these days. MPS is probably the most widely used solution in the marketplace at the moment and the one that's growing the quickest. There's 2 types. You've got your advisory portfolios that you build yourself that you offer clients. And then obviously the main area of popularity at the moment is outsourcing that. So there is a lot of choice in the marketplace. So you've really got to narrow down, well, what do I want my investment philosophy to look like? And then picking a partner that aligns with that. And they all do act slightly differently to one another as well. And then lastly, you've got things like multi-asset funds. This is something that I think people were traditionally used to. It's relatively simple, very good, obviously, for clients with general investment accounts where capital gains tax a worry. Optically low, as we put there, is not really much to talk about. A client seeing one particular line on their, say using Fundment's online portal, they log in and just see one individual security. There may be some doubts about, well, what can we actually talk about? We're seeing a portfolio of assets and actually seeing maybe which funds have either performed or underperformed and having more of an educational conversation around that. Obviously, gives you a bit more to talk about there instead, but still a very popular option and nothing wrong with it at all. And then this is your ancillary options, the things that maybe you wouldn't have considered previously, but people have started to start really using more and more now, especially with the rise of interest rates. A lot of these solutions are coming out. One of the things I didn't put in there actually was even things like annuities could be part of that ancillary option. But you got smooth funds, which are popular. Obviously, proof funds probably the most well known out of that range. So good if clients just want that predictable, sustainable return. Challenges around sort of lack of transparency, high costs. Will your growth be left off the table as part of that? Alternative funds were really popular at one point. I think quite a few people remember GARS. That was one of the most popular funds in the entire space until it wasn't. And it didn't pay exactly how people expected it to. But there are still some really good solutions out there that people should be looking at. I mean, Ruff is a good example of one of those that have done a really good job recently as well. Inclusion of PE money. So if you've got clients that are more high net worth that can access those sorts of environments, great. But there is quite a high barrier to entry. And obviously, a very topical theme. I mean, Lee, you guys have obviously had a lot of sessions on this, the IHT space. So your sort of AIM providers, EIS. So it's understanding that actually you don't just have to pick one thing. You can pick a combination, but there's a variety of different toolkits that you have available. How we provide people with that goals-based CIP approach, as an example of that, we broadly think that actually you maybe want to offer clients say a solution of main ranges. So Francis mentioned this earlier. So you might have, for example, five core risk categories that you offer clients. So defensive, conservative, balanced, growth, equity focus. For us, it simply goes 20, 40, 60, 80, 100% equity. So it's nice and simple and clean. But then it's about the styles. So we have a core range, which is your active passive blend. You then have our passive plus solution, which is effectively passive at its core, but active when it matters. So we do have an element of tactical asset allocation that we can implement there. So 2022 is a good example where we were able to go into short duration bonds instead of long duration bonds. So really protected capital well during that environment. And then you have your sustainable solutions, your income solutions, people that want a natural yield. Very popular for anyone that's dealing with trust work that need to pay out maybe sort of their 5% withdrawals in a nice, clean way. Interest in possession trusts where there's obviously a life tenant that you want to pay away the income to, and obviously you want to keep the remaining capital for the remainder men within that. And then multi-strategy for us is a GIA solution. So that's the core. And I think a lot of you will be very familiar with a lot of these solutions. But what we're going to talk about just now is things like the satellite portfolio. So this is where you start to get more goals-based thematic portfolios that all fit on that 1 to 5 risk spectrum, but there's a key theme and objective they're trying to achieve beyond just simply investing in the market. So Cash Plus is literally just that. It's looking to get cash returns, but net of fees that are in line with base rate. So incredibly popular option at the minute, especially for that short-term bucket. Those clients that are wanting an alternative to platform cash, because obviously we've all seen the reports that some platforms have been double dipping for some time and not offering the most attractive cash rates. Gilts has really been popular over the last few years as interest rates start to rise. There's now a load of gilts on the market trading below par. So it means you get a capital gain tax free for any of those gilt holdings, which is a really good alternative to cash if you've got any higher rate taxpayers. Also corporate clients as well, because corporation tax benefits from the same principles as well. Capital preservation. So again, if you've got like a defensive client, whereas actually they need a little bit better than cash like returns, but they don't necessarily want to take the risk, that's something that you can offer them. Four Seasons is really good for those clients that I think we've all spoken about there. Actually, we find out quite a lot of clients fit into that space. I think James, obviously, you mentioned it around a lot of clients fit into that sort of like conservative or maybe average risk camp. People that want equity-like returns but just don't want to take the risk. Four Seasons is a great one for that. It's just a truly diversified portfolio. High income is then basically targeting 5.5% yield as opposed to 4%. Global megatrends is for the bold and the brave, the people that want to take a bit more risk, have access to things that they think are going to be the future in the world. So AI is a key trend that we put in there. So you have AI exposure. You also have healthcare exposure to do with our aging population. You then have things like emerging market exposure as well. So looking at the fact that a lot of these AI companies and stuff now, a lot of the components that are built are in obviously emerging markets. So some really good long-term themes. And then smaller companies is for anyone that's done a dimensional presentation and wants some of the factor tilts is always a good one as well for longer-term investing. So that's the satellite portfolios and roughly how they work. But I'm just going to skip through this and go straight into the case study so we can really help go back to that original point of the FCA, how you actually line client solutions to their goals. So let's just say we've got a client, they're 45 years old, good health, as James put it, I think they're an average risk investor, so they're just a medium risk. £150,000 in a general investment account, £100,000 in an ISA, £450,000 in a pension. They have not come to you, sorry, Francis put it a minute ago, because they're a medium risk investor. What they've actually come to you with is these three requirements. So after your conversation with them, you realise that they're looking to fund a house purchase in the next 2 years. They've also want to give their child the best opportunities in terms of education, so want to do some private school fee funding as well over the next 7 years. And actually, they're only 45. They've probably got a good 20 years away from retirement, so you've got a long-term goal in there as well. So as you can see, some quite conflicting objectives that we're going to have to try and meet, that if we just shoehorn them into an average risk portfolio, probably might not meet that. So the solution, and this is again just an example of using building blocks of Aspen, but you can use a full suite of options within that. Okay, I'll give you some examples as we walk through it actually as well. So general investment account, we're using here the Aspen Cash Plus portfolio to get that net of free return in line of base rate. So again, we want some form of growth, but we do not want the volatility associated with that. And we don't want a potential scenario like 2022 where suddenly the portfolio falls by 20% just as we're going to complete on the house purchase. I mean, I think everyone here, or majority of people now have gone for a house purchase and appreciate how painful that process is. There's always some last minute surprises and just don't let it be you causing those issues as part of it. So you've also got things like platform cash. So people want some good examples. Transact's really good for platform cash at the moment. Let's say I think there are quite a few people quite happy with that. You can use some things like fixed terms deposits, and I think Cygnus have a cash platform as well. So there's a few different options in the marketplace for cash now as a result. Or you might even use things like the gilt portfolio for those clients that are high rate taxpayers or additional rate. So Four Seasons is going to be, like I said, getting those inflation beaten returns, but without those big shocks to the system. So we're going to put £100,000 in that. And then because we've taken lower risk with the first part of our client's wealth, that first £250,000 they've got, it then means that with our retirement pot, we can start to take a bit more risk and still meet an aggregate medium risk profile. So we can actually put them instead of a balanced portfolio into a growth portfolio instead. And hopefully, we might see an example of that in just a moment, probably get at least 4 or 5 years worth of additional income from that solution alone. But the most important thing is this all in, including DFM fees, underlying fund fees, is 0.36% all in for a custom solution. Now, if you went to a bespoke DFM who would do something like this for you and maybe create more of a bespoke investment strategy, you're going to be paying close to 1%, but most likely over 1% as a result of that. So it just goes to show you can start to really have the freedom to build a tailored solution now without all the additional cost or administration or burden by doing so. So that's just a very quick case study. I'm just going to hop over to the other screen just so I go through the tool and show you what that looks like as well.
One of the things we noticed when we were looking at risk profile, I touched on it just a moment ago, risk profile based investing and then goals based investing is, one of the challenges with goals based investing is it can be quite complex, and of course goals do change over time. So what Lewis is going to show now is just a way that we can make that a bit easier for financial planners through the use of some technology.
Yeah, and tech plays a key part of our lives now. And this is basically why we built this toolkit, because we did want to provide people with that full toolkit of portfolios so you can start to have genuine choice now and more goals-based approach to investing. But it's how you bring that together. And I think I'm going to go back to one of the first things you said about is about how do people move to having more educational conversation around risk. This is exactly what this sort of tool's designed to help you with. So you have this completely in Aspen branded as this one is, or you can have it in your own branding. It's a complimentary bit of kit. We don't charge anything for it. Anyone that uses our portfolios gets access to this technology as well. So if we go into a guided portfolio builder journey as an example of that, I'm just going to add a client. So Francis, you can be our client today. And I'm just going to put some details in. We know they come a medium risk profile, but if I want to map across against any of the third parties like the Facto, EV, the Dynamic Planner, I've got all the third parties there to see clearly how each of those solutions maps across. So I've got Francis here. Sorry, Francis, I'm doing you a disservice. You are not 45 years old. Yeah, I'm aging you horrendously here. Apologies. But let's just say we've got the start building those solutions we spoke about a minute ago. So we said there was two, was it £450,000, was it, Francis, in the pension?
Yeah, that's right. There's 450,000 in the pension, 100,000 in the ICE, well, 150 in the individual account,
That's it. And
and
then
then
ISA was
100 in the
100,
ICE.
wasn't it?
Yeah,
Perfect.
that's it.
So we've got this in here now. So we've started to build the solutions that we need to actually create a recommendation for. You can add some notes in. So you can put, for example, I'll just put Francis 45 and uh, medium risk from de facto. Just show like where we've mapped that across from as an example of that. So now I've got the solutions. I can now start to create the goals for Francis. So actually, let's have a proper conversation around what we were initially investing for. So we said the house purchase is going to be a
House
key
focus.
one, and that's
Yeah,
going to be 1 to 3 years. You then got
school fees.
that's it, uh, and that was going to be medium term, and then we had retirement as it was over 20 years away. So let's put long term there as well. So, medium risk profile, fantastic. What the tool now enables me to do is say, right, I've got Francis here, I've got his tax wrappers, I've got the three effectively goals I've built for him now. I can now start to look at assigning goals to those, assigning investment solutions to those goals and seeing what impact that has on risk. So, we said the house purchase was going to be the individual account,
GIA, yeah.
and we're going to say the cash plus portfolio, and that was going to be for the £150,000. And then school fees was going to be the Four Seasons portfolio as well. So let's just add that in there. And that's going to be £100,000. But as you can see in the bottom left, if you just cast your eye to the bottom left hand side of the screen, it's actually telling me that based on what I've currently recommended alone, I'm actually outside my client's agreed risk appetite. I'm actually at 1.4 out of 5, when really I should be right trying to aim for a 3 out of 5. So it just goes to show because you've taken lower risk with the first two pots, but what happens if we went from a medium risk profile and instead of putting them into, say, a balanced passive plus, what if we put their pension into a growth passive plus solution instead? So I'm just going to use that example and go with a growth passive plus, and we're going to put the remaining £450,000 in there. So there you can see I'm pretty much bang on my medium risk profile, 3.1 out of 5. Apologies, I incorrectly quoted the costs earlier. It wasn't 0.36, it's actually 0.34. That's because our passive plus range has recently had a reduction in underlying fund costs. But what we can now do is we've now built this more tailored solution for the client. But if you then want to educate the client on that, you can bring up our interactive charting and you can then, it will automatically pull through the value. You can then customize the date ranges you want to. But let's just say we're going to have a conversation with them about the pension pot, why we've decided to go one risk level up. So we said they initially came out as a medium risk, but we've also put this solution into a medium high risk portfolio. Well, a £450,000 pot over 25 years, if it's a medium risk, you'll end up with about £1.75 million. If you're a medium high risk, you're at £2.1 million. So, if, for example, this client was going to say, for argument's sake, £50,000 a year in income in their retirement, what we've effectively done there is create 8 additional years worth of income just by going one risk level up for them. So it just does really show that actually you don't need to go into, for example, 100% equity investing as part of that. You can show them then things like inflation. You can show the client the world events that have happened. You can show the market downturns. They might see something like this and get really excited and be like, oh, that's great. Why don't we put our school fee funding in there? Or actually, why don't we even put our house purchase in there? And that's when you then start to have a more educational conversation with them saying, look, let's just go into the COVID-19 outbreak as a good example of that when we had a brief downturn. So in COVID, a medium high risk portfolio fell by 12%, a medium risk portfolio fell by 7%. Realistically speaking, the 150 grand we've got for you, if that fell by say £15,000, would that have affected your house purchase? Yes, most probably. That's at least probably contributing towards some stamp duty, solicitor fees. It's just showing them exactly why we're investing this money for longer term horizons, and actually we're happy to take more risk, and why for the shorter term horizons we actually want to reduce risk and give them something a little bit more sustainable in there as well. So you can have a really engaging conversation around risk versus reward for them. But once you've done all this, you can then finish and save, download a report, and the report will effectively go through everything we just gone through. It will map everything across. It will help actually align the recommendations with the appropriate goal, and then it will give you that aggregate risk score and aggregate cost score at the end. Again, this report will be completely white labeled if you have it in your branding, or it can be in Aspen's branding. So we talk about how we work with you, how you work with the client, the pension, individual account, and the ISA with the recommendations we're looking to do today, the goals of house purchase, school fees, retirement. I've got my agreed risk profile, and now I've got my recommendation with also the notes I've put in there as well. So I can clearly see how each one is aligned, and it will also then put in any of the fact sheets I've got for the solutions that I've recommended as part of that. So a slight caveat to say that if anyone's using our tool, like I said, you don't have to use the Aspen solutions. You can add your own customized solutions. You can use our satellite portfolios alongside whatever you've currently got in your toolkit. So I'm just going to get rid of Cash Plus as an example of that. And let's just say we want to stick that in. So I'm just going to mix it up. Let's put Fundament Platform Cash. Obviously, there's no investment cost for that. It's just the platform cost. So we're not going to include an investment cost into this one. We know it's a 1 out of 5 in risk. So you can add a custom solution, allocate the money to that as well. And the tool will still help calculate aggregate cost and aggregate risk for you. As long as you know the name of it, the cost and the risk profile, away you go. And it's nice and simply. So that's what we're trying to do in terms of really trying to help clients evolve that conversation around risk versus reward as part of what we do. We've also got some other stuff on here in terms of our useful resources. Lee, you mentioned earlier about what happens when clients actually experience volatility. So we've also got on here, for example, a staying invested pack. So some really useful infographics that you can just basically bring to your client conversations and just walk clients through that actually, why is it important to stay invested? Why you shouldn't react? And for some clients who say, well, surely interest rates are good at the minute, should I not just hold cash? You've also got some arguments as to why you want to be invested versus holding cash as well. So yeah, some really useful tools that quite a lot of our advisors now use, and said it's really been useful to help educate clients on risk versus reward. That's it in a nutshell.
3 minutes to spare.
Yeah, that's
at
close
that.
to the time at the end there.
Yeah. Guys, that's great. I love it. I love seeing the tech as well. The tech is evolving. What I love about the whole Aspen tech is the simplicity of it. It's just so easy to navigate. It's so easy to use.
Yeah.
Which is, hats off to the dev team on that and the idea behind it. So really, really good. Always over to the audience. If anybody's got any questions, please do let us know. If anybody wants to see any part of that portfolio construction as well, let us know. These guys are always happy to hang around. So if you ever want to see anything in particular, we can absolutely walk through it with you. Likewise, when you end today's webinar, there will be a question that says, do you want to speak with Aspen? Let us know there and they can set up a call and walk you through something in a little bit more detail as well. So I know everything today was quite high level, bit educational and just show you what it's capable of. But if you want to see it, firsthand in a little bit more detail, let us know in the feedback form and we can set up some calls for you. Not a problem at all. Aside from that, we're 1 minute out. Thank you again for joining the club. Thank you for joining Aspen today. I hope you all have a great Friday. It's supposed to be very hot this weekend, very, very hot. So much like myself, I'll be on the side of a football pitch all weekend with the kids, all fun and games. But thank you again for joining us, and we hope to see you all again soon.
Yeah, thank you, everyone.
Not if you're on my plane, you won't.
Exactly, yeah. Okay. We might not see you and James anytime soon.
Yeah.